This week, we've got something special. We're talking to a portfolio manager for a publicly traded company, mutual funds and ETFs, who actually makes the wealth decisions on behalf of retail investors. We're going to talk about process and how that person makes better wealth decisions. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. My guest this week is Onno Rutten. He is Vice President, Investment Management and Portfolio Manager with the McKenzie Resource team. Onno's career in the investment industry began in 2003. He joined McKenzie Investments in 2011. And prior to joining McKenzie, he was a precious and base metals equity research analyst for a global commodity strategist firm. He's widely regarded in the industry for many years. He holds an MSc from Delft University in the Netherlands and an MBA from INSEAD in France. Onno, welcome.
Hi, John. Thank you for hosting.
It's excellent having you on because the podcast is called Make Better Wealth Decisions. And oftentimes I have academics and journalists and other people talking about decision-making in finance. And I've had 3 or 4 people who are portfolio managers for private products, offering memorandum products. But to the best of my recollection, after 180 episodes, you might be the first guest I have had who is a portfolio manager for publicly available retail investor available mutual funds and exchange traded funds. So it's exciting to have you on because now we have an opportunity for people who do investing, who give their money to someone to manage a mandate on their behalf, to hear how the person does what he or she does. To use terminology I've heard you use in the past, to pull back the curtain and show how the sausage is made. That's wonderful.
The pressure is on.
Oh, yeah. Pressure's on. Let's begin by having you set the stage to go beyond your bio, to tell me a little bit more about your backstory. And then I'm going to talk to you about the trends that we see and the macro indicators that you're looking at, but maybe a little bit more about yourself to begin.
Yeah, thank you. I guess a long winded road careers that were always has been focused on metals, mining and resources, literally from 10 years onwards. That ultimately led me to go to the dark side later in my career, the financial side of the industry. But a strong belief that if you stay close to a core competency throughout your whole career, that's actually where you can contribute the most value. The transition from being an engineer in the mining industry, I worked in Africa, in Australia, ultimately came to Canada through that work, always kept me close to the rock, let's say, and to the metals. But then there was a desire to get better understanding of what truly drives the macro allocation on this world. And that's where I followed the capital essentially and went into the financial industry to see how capital allocation in the resources industry gets done. I'm speculating here. One of the reasons why I'm maybe the first one on your podcast is we are not your general balanced fund managers. We are a niche team here at McKenzie of purely resource investors that has been in existence since 1978. So this is not some fly-by-night China fund. I got to meet this team when I was on the sell side. And there's maybe only 10, 15 teams like this on the planet that purely focus on resources. And the reason for that, of course, is the deep cyclicality in resources. A lot of these teams wipe out in the down cycles. The beauty of it is resources is 20 to 30% of global earnings. So even though it's underrepresented often in the press, in your portfolios, etc., it is a big chunk of the world economy. And that's what motivates me, is to be so close to something that's so important to the fundamental economy. So the team here is 2 PMs, myself and Benoit Gervais. We're PM number 2 and 3 on the fund.
It's amazing how long the McKenzie offering has existed and how little turnover there has been all the way through. So that's rare in the industry because, as viewers would know, it's not uncommon for people that are managing mutual funds and exchange traded funds on an active basis to change every 2 to 5 years. So to go on for decades at a time, Okay, so let's begin getting into the weeds here. I wanted to begin by asking you to talk about what you might call multi-year themes and cycles with regard to the sector level. I'll leave it to you to tell me what they are, and I'll go a bit deeper when you start asking.
Yeah, your original question talked about process. And process, let's unpack it today a bit. And the traditional PM would start talking about his favorite company and why it's such a great company. I think what we try to do with this long horizon that we invest in, so we typically look 5 years out as a minimum. And secondly, we are in the cyclical industry. We look at the macro thematics first and do research on a sectorial level before diving into the individual companies and equities. And the multi-year themes and cycles that are really of relevance are deglobalization in particular, because we have to essentially re-industrialize the Western world. All industrial development over the past 20, 30 years has been in the East, China in particular. And with that, we eroded the entire industrial base. And being a resource is, let's say, the basement level of building up an industry. And we need to duplicate. It's not going to be efficient, by the way, from a macroeconomical perspective, but we're going to duplicate value chains because society has decided that we want to have those value chains closer to home. Tariffs are just a tool in that. And they get all the headlines right now, but they're just one of the few tools to get the industry to come back. The other thing that's been totally neglected is infrastructure. Since 2008, governments went bust. And the first thing where they stopped investing was infrastructure. Needless to say, here in Toronto, you can see the effects of not investing for 20 years in infrastructure. And that requires cement, steel, rock, etc., aluminum, copper to rebuild. So that's the deglobalization, infrastructure thematics. De-dollarization is a massive one. And it's accelerating right in front of our eyes. We've been on this thematic for many years when we saw central banks starting to turn into aggressive buyers of gold to diversify away from the dollar. And we saw the weaponization of the dollar through sanctions over the past decade, which obviously was going to affect the behavior of non-dollar economies in the world. And commodities are an alternative currency, and gold being the most extreme one of that. They are independent measures of value, stores of value, and they can easily be traded. So they fit the definition of a currency. The energy transition, we've always said, would take much longer, would be much harder than what the politicians were promising to the populations and the companies were promising. But still, it is a societal trend that will take the next 20 to 30 years. The impact will probably be at least 1% of GDP investment for the next 30 years to get this done. And in there, you can talk renewables, you can talk about gas as a bridge to renewables and transforming industries, high-emitting industries. And then lastly, the commoditization of commodities. Commodities, historically, steel was steel. We're now going to differentiate. There's Chinese steel, there is recycled steel, there's green steel. And with that come price differentials, come niche markets. And we are coming much more in the realm of what you normally would find very interesting, companies that have something special, a special mode, which normally wasn't the case in commodity markets over the past decades. So these are some of those macro themes that drives the portfolio from a thematic perspective.
Okay, so thanks. That was a great overview on the general. And now let's see if we can ask you to do us another favor and go one step further and drill down to the specific. What exactly are you looking for when you make decisions on what to buy, why, when, how? Tell me a little bit more about your decision-making process as a person who's actually making the calls within the context of the themes that you've laid out with regard to individual.
Yeah, I think we're highly differentiated there. First of all, the team here is all consistent of engineers and scientists that later in life went into finance. And I'm a strong believer in that the biotech sector should be covered by a PhD in biology and not by a BCom with a CFA. There's a strong belief there that you have to be able to understand the actual assets of an industry before making a call. What do we do with that skill set is we go deep on an individual asset level. Especially resources are very asset driven. Ideally, you have the perfect combination of management, a balance sheet, and a good asset. But where it all starts in this industry is with the assets themselves. Do you have a good oil reservoir, a good gas well? Do you have a good gold mine? And it goes back to the rock. So we do those deep dives through site visits. So we travel the entire world. We go down, 2 weeks ago, I was 2 kilometers deep in Timmins at a gold mine, stretching the rock. 38 degrees, 100% humidity. You can barely breathe. And now you have to imagine, can a miner actually work productively in an environment like that? And then get the rock 2 kilometers up to the surface. And then you have to deal with the community that's right there, because the mines in Timmins are in the town. The slide deck doesn't capture this. You have to get the boots on the ground. So the safety boots are next to me here in my office. They get used every week to go visit assets. We use expert consultants. We use very little the generic street research, which has eroded massively in quality over the past 10, 20 years due to well-publicized conflicts of interest. So we use more consultants, retired industry experts, etc., to help us in those deep dives.
Okay.
And then it comes down to valuation, I think. You want to step to the next step, and that's really the buy-sell decision is valuation, ultimately.
So let's talk about the lens that you use then in making decisions, sustainable free cash flow, valuations, metrics, that sort of thing. So maybe take us through maybe 4 or 5 different key metrics that you would use in trying to make a decision about the valuation of any given option that you have.
Yeah, sustainable free cash flow, I think by now is a more accepted concept. It wasn't 20 years ago, I would say, when we wrote white papers on this. The bottom line here is that accounting measures often do not capture the peculiarity of a certain industry. Earnings are by definition generic accounting metrics. The problem for the resource industry is that one, your asset is depleting. So your earnings go to zero if you just run down the asset. So there's a certain level of capital needed to continuously replace that reserve base. The second issue with it is that accounting doesn't take into account the capital intensity today. It takes the capital base of the past and divides that by 20, and that's it. But if your reserve blows down in 10 years or in 5 years, like a gas well, then that accounting depreciation is not the right measure. So earnings don't really reflect the needs of the businesses. So we look very much at the capital intensity. How much does it cost to build a copper mill? How much does it cost to drill your next gas well? And that's where that industry expertise comes to play, where you put a price tag on these things. And then you say, that's the amount of capital that's needed to sustain the business as a going concern. And as long-term investors, that's what we need to know. What does it actually cost to keep this business going? So what that boils down to for us is a sustainable free cash flow metric. Surprisingly, maybe to you, is we spend less time on commodity research day by day. What we look for is medium-term, low, mid-high commodity price tags. And imagine the low being a recessionary environment where the world doesn't need metals in oversupply or too much oil, too much gas. And then the mid case is where the industry can sustain itself. The high case is where the industry can grow. And that's where it gets fascinating in those 20-year commodity cycles that you've observed. The last one was in the early 2000s, where the industry gets caught short and the price level needs to rise to a level where you build new mines, new wells, new supply. That's the incentive pricing. And then we take that as the revenue and we look at the capital intensity, and there you have your metric. And the discipline really is, of course, to buy when you're at attractive, sustainable free cash flow levels under the given scenario of where you are low, mid, high in the cycle. And that is very much a aggressive discipline that we apply. So you could put us in the value bucket of investors, but then let's call it cyclical value.
Cyclical value. Okay,
And then
so
we look
let's
at growth 2-3 years out. So that's where the GARP comes in. Apologies. But the growth, of course, is measured in the pounds of copper per share or the barrels of oil per share. That's how we come to the valuation discipline.
Maybe you can take a moment to walk us through how you make decisions to buy something and decisions to sell something else. What goes into that? What are you looking at specifically?
The one thing we talked about is where are we in those macro thematic cycles? So for us, lithium, as an example, was all the rave 2-3 years ago. But we looked at the application of lithium and we said that electrical car is still not competitive against a combustion car. You only get killer adoption, accelerated adoption, when something is clearly superior. Subsidies can push you one way or another, but the only way really to get adoption is something that's clearly a better mousetrap. And the electrical car wasn't a better mousetrap yet. So we said it's going to take much longer. And therefore lithium, interesting, but the price going from $10,000 to $70,000 per ton of lithium, no need for that. And then lithium came down and today it's $8,000 per ton. So where does it fit in those macro thematics that I started the conversation with? Then I think what's very important is a quantitative discipline in portfolio construction and risk management. And I have criticism to many of the practitioners in the industry that are very much infatuated with their favorite stocks, but then lose sight of the overall portfolio risk and exposure. And we felt it the hard way, given the cyclicality in resources. The down cycles were the moments where we would lose investors like yourself. So we had to manage volatility much more rigorous. And for that, you need to do risk modeling. And there is standardized risk models that more practitioners in the industry should be using, but they are fundamentalist and they don't want to listen to the quant or work with the quant. We have an onboard quantitative analyst for the past 13 years that helps us with the risk analysis. And with that, the building of customized risk models. So knowing where the risk sits in your portfolio on the fundamental level. So we can say we have overexposure to the US Permian oil and gas region, or you have too much exposure to metals in Africa, regional exposures, etc. And we model that in an abstract way and unbiased way. And lastly, macro is very hard to predict and quite often leads you to emotional decision making, panicking at the wrong point in time, market following. And that's where ETFs often beat the active manager by being non-biased. What we have resorted to is building macro models, macro indicators. I think of macro indicators. The obvious one is PMI. It's the futures curve shapes in commodity markets. It is currency movements. It's industry-specific leading indicators. And it's also listening to the market itself. So market cycles, market momentum. And quickly you get into a world where you have to use machine learning tools. I'm not going to use the word AI today. It's just machine learning, and it's feeding the thing enough data so that it can start looking for patterns. And patterns that the human brain is often biased by. Oh, this is not related to that. Whereas the model says these two are correlated, and therefore pay attention. Why machine learning? Because statistics normally are linear and our brains are linear. When it gets warmer outside, we remove our jacket and it's a linear behavior. But now what happens when there's a sudden storm? And when you get into those tail events, the machine learning models are non-linear by nature. So it can say, don't look at this metric for 98% of the time, but 2% of the time, really pay attention. And the combination, I think, of that type of modeling with the quantum fundamental analysis still has a future. If not, then ETFs are quite often the alternative for investors like yourself. And if the active manager cannot consistently outperform the ETF for the given sector, then there is no future for active management. And I'm very outspoken about this. That is the value add proposition. And if you can't make that, you should do another job. And I hold that up for myself as well.
Excellent. All right. So Onno, let's see if I can summarize this before we end. To me, my big takeaway is the cyclicality of resources in general. And what I would say in particular is that the world that we live in the second half of 2025, we've got wars, yes, we've got tariffs, we've got deglobalization, and the tariffs are accelerating the deglobalization, but we have to reshore, friendshore, buttress our own supply chains in order to reindustrialize the Western world. And those are things that we read about all the time. We read the front page of the newspaper in terms of what's going on in politics. But not everyone connects those dots in terms of what that means for their portfolio in terms of, so how is the economy going to morph to take into account these new geopolitical realities that are very much part and parcel with the world today? And do you think people have come to realize to make that connection? Because my sense is that they haven't, at least not really. But what about you? What do you think?
I think two answers to that. I think one, the short-term fears that people have because of the violence and the speed at which things are changing around us makes us nervous and therefore pull back on risk. Whereas I believe a lot of these themes that you raise are investable themes, but it requires investors to get out of the traditional 60-40 type of portfolio that people have been in for the past decades. Remember the 60-40 portfolio with a 7-year duration of fixed income and a very US-heavy growth-focused equity component was the natural evolution of 20 years of steady deflationary trends on the planet. And that's really what the ideal portfolio for that environment gyrated to. Now you have to say those things are changing rapidly. Yields clearly are behaving very differently today. Inflation wasn't a factor for the past 20 years. It is one over the past 3-4 years. And you have seen what damage it can do to a standard 60-40 long duration type of portfolio. And I think people should not scare away. They should embrace the change and say, okay, what's next? Are European equities better than US equities? Is short duration fixed income or TIPS better than long duration fixed income? And inflation, let's go back to the 70s and 80s and study what inflation did to various asset classes and implement that to the portfolio. I think that's the forward-looking way of dealing with what we are witnessing here.
It's so wonderful to listen to you speak because these are all themes that I've touched on in videos that I make in with other guests frequently. The themes are the same. The world has changed. 60-40 was fine in the past, but it almost certainly is inconsistent and insufficient going forward. And you can't look backwards to make decisions. You have to look at the world in front of you, and the world has changed. And we need to acknowledge that. And my concern is that many of my financial advisory and portfolio management brethren continue to make decisions about the future based on what worked in the past instead of acknowledging that the world has changed. And I find that dismaying, and it sounds as though you're agreeing with concerns. Thank you. Onno, I always like to end with the question of the podcast is called Make Better Wealth Decisions. If it was up to you, what one kernel of wisdom would you offer to people to help them make better wealth decisions?
Somehow remain disciplined. I might have bored some of the listeners with some of these intricacies about portfolio management, how we apply it. But I think what I try to convey in that is we couldn't be just, I'm infatuated with rocks. Let's put it that way. That's clear. Okay. I love my rocks. I could not have a long-term sustainable career in asset management if I would just let that emotional guideline guide me. You have to build in analytical rigor, independent indicators that help you guide your decision making. So whether that's through an advisor or through your own modeling or through informing yourself better about non-consensus thinking, you have to have all those signals in some systematic way to actually come down to a portfolio that makes sense for you. So be less emotional, be less newspaper focused, be more fundamental, more numerical driven in your decisions.
Onno, thank you so much for your time today. It's been a real pleasure, and I want to wish you all the best going forward.
Thank you, John, for the opportunity. Enjoyed.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.